Hi. Hi, Joshua. Hi, Eugene.
Hello, good afternoon.
Yeah, you're good?
We're yet to begin, so let's just give the rest time to
Yeah.
join.
So how are you going to start? Are you going to share, to screen something, or I just put my slides on?
Or let me share my screen.
You're going to share your screen first, right?
Yeah, yeah.
Oh, okay. Yeah, that's okay. Let me try to share mine. I see first, we just test the sharing first. Then I can actually remove.
No problem.
Okay. Yeah. So those are the slides, that will be shared. That's okay. So then I can stop share.
Oh, fine, fine.
Okay, thanks.
Good afternoon. I would like to take this time to welcome all who joined and got an opportunity to join. And let's give an allowance of 2 minutes for the rest to join so that we can begin by 12:10. Otherwise, just be patient, and you can also invite your fellows. Thank you. So good afternoon once again. My name is Joshua from Kapabil, and I'd like to welcome us once again for this webinar. Today we're going to discuss on financial freedom, that is tax strategies for maximizing income and wealth. And our speaker is going to be CPA Peter Kioko, and I would like to take this time to invite all of us to join this session, and I'd like to give a chance to CPA to say hi and also to just begin straight away since time is not on our side. Yeah, thank you and welcome, CPA.
Yeah, good afternoon, everyone. I'm sure, Eugene, you can hear me, right? I mean, Joshua, can you hear me?
Yes, you're
Good.
audible.
Then I believe everyone can hear me. First of all, I think in the first webinar I'm training for the last, I think, 2 years or so. I have not been active in the training of the webinars, but I've been in the field. I've been in the training for the last 5 years, and I wish to thank everybody who has joined us. I can see Anthony Karibu. I can see Cornelius. I think I met him about the last time we met is sometimes back. I can see Zipe Doris, Hillary, John, Joshua, Michael, and others who will be joining us as we progress. So I would request that maybe you can actually do away with your sharing so that I can share my slides. You can stop sharing. Yeah, there we are. So my background is, as we've heard, I'm a certified public accountant. I also have a master's in finance, and my BA is in economics. I also have a BA in communication. So I'll be with you for the next 45 minutes. And I think what we are going to do is actually to discuss when we talk about financial freedom, what do we talk about? What is it that is financial freedom? How do we link it with taxation? In most organizations, in conventional organization, we have what we call the cost drivers. If you look at the organization perspective, the cost drivers are usually three, and either can be the highest or the lowest. So we have one. Tax is actually one of the three. The first cost is actually what we call procurement. When we are procuring goods and services, it is actually the biggest cost driver in most organizations. The same thing when it comes to you as a person, the cost driver is actually the things that you buy with your money. Then number two, the second cost driver in organization, what we call the staff cost. And the tax, so staff, that is actually the wages and salaries. Then number three will actually be tax. That is true to most organizations. However, to others, organizations like EABL, organizations like Safaricom, you may actually find the story changes. Reason? Because they pay so many taxes. So you'll actually find tax is a cost driver in most organizations. Tax is actually the biggest component in most of these organizations. Some of them are paying about 40% of their revenues in form of taxes. If you are producing exercisable goods, you pay excise duty. Excise duty you pay even before you start selling your products. Excise duty could be as high as 20% of actually what we call ex-factory prices. Ex-factory cost, sorry. Then after that, after you pay excise duty, you still have to pay VAT on the goods based on the sales. Then after that, you still have to pay corporate tax. You still have to actually pay what we call PAYE from your employees. Then after you've computed and made your profits, you still have to remit 30% of your profits to the taxman. Then what remains is actually what is supposed to be distributed as dividend. If you decide to eat that money, that is to actually distribute the dividends, again, you are going to pay what is called withholding tax on dividend. So apparently, you actually find that taxes are actually consuming about 40% of your revenues, and it actually becomes the biggest cost driver. So for you as a person, the same thing applies. if you're actually consuming excessible goods, like for us men who are not planning to go to heaven and we take alcohol, uh, you'll actually find that once you get your salary of 100,000, 30,000 has disappeared before you receive your paycheck. The other 70,000 that remains, if you're actually eating 20,000 in luxury items, already these items have actually been exercised. That there is excise duty, there is VAT, there are other variety of taxes. What does it mean? About the researcher, it has actually been shown that about 50% of our income is actually being spent on taxes. So based on your paycheck, what goes to you as a person is actually 50%. The other 50% goes to the taxman. Now, this is true, especially if you are in the middle class. Middle class means what? That we consume highly taxable goods. Remember, if you're actually from the base of the pyramid, we normally consume what we call the basic goods. The basic goods, you'll actually find most of them are actually not exercisable, others are actually not vetable. That is what happens. So we are going to start first of all. So in short, what we are saying, if you can manage the three costs as an organization, if you can manage tax, employee cost, and procurement, you are good to go. You don't need to worry about tomorrow. Tomorrow will actually sort itself. The same thing we say if you are a man, as a man, if you manage three things, the first thing, if you can manage your money, that's the first thing. Manage your money. The second, you manage alcohol or entertainment. The third one, I think I'll give you before we break. You don't need to go to heaven. You can enjoy life here on earth. And you're actually going to be the happiest man here if you can manage the three things. So let's start with financial freedom. Then we link it to tax. So the Bible tells us about managing money. If you look, Jesus talked about three people. The first person was given 5 talents. The second was given 2. And the third was given 1. The first one allowed the money to work for him. Of course, based on actually his capacity. The second one allowed money to work for him, not in a high extent because again he was limited. Remember the first one, this is actually what we call the upper class. These are people who are earning good money. And the money will actually work for him because he can actually be able to invest it. The second one had 2 talents. What it means with 2 talents, the investment opportunity could actually be very rare, but he was able to get something and invest it. The last one, he said is poor. The salaries he's earning is very small, so that money will not make sense. This is why we say that since the money you are having may not make sense, why would you want to actually grow something that does not make sense? So he decided, let me put the money in the pocket and let's wait if it's going to grow. Of course, it didn't grow. Of course, we know what happened. When their master came, he actually accused the other fellow of actually not being lazy and not using his brain to expand his frontiers of knowledge. The money did not grow. Reason? No effort was actually put in place. God provides us with the knowledge and tools in the Bible for sound money management. So we talk about God is more concerned about stewardship and accountability for money and finance. So, how do you achieve financial freedom and what is actually financial independence? When you talk about you are financially free, because remember, when we are training people about retirement, we tell them your goal should actually be financial freedom. That's what we normally say. Where you're actually not worried about the next coin where it's coming, where you can actually continue with the same standards of living in perpetuity. If you can actually be able to maintain your standards of living in perpetuity, we're saying you are actually financially free. Remember, we're saying financial freedom because you could actually be a slave of the other things, but in terms of money, you are not free. So what we say is actually you have actually achieved, if you can actually be able to achieve that you can actually sustain your standards of living in perpetuity, we'll actually say that you actually achieved the highest level that money can actually take you. Remember, the highest level is not having billions, it's actually being able to sustain yourself without really worrying about tomorrow. So financial independence means having sufficient income. So I'm not going to read the notes because I know the notes we can actually be able to read for ourselves. But I think the definition of financial is actually we are free if you can actually be able to meet your goals, and your goal should actually be freedom. You actually have sufficient income. So a big part of financial freedom is having your heart and mind free from worry about the what is of life. That is usually the biggest problem we have. that in case it rains tomorrow, in case I lose my job tomorrow, what happens? In case a disaster strikes, what happens? So those are the questions we normally ask ourselves. What if this happens? So financial freedom, we say, is actually your heart is free. You are not asking what if. Reason? Because the future is already taken care of. So for us to talk about financial freedom, you said we must have a vision. And the vision is actually financial freedom. So here we are talking about money. Remember, oftentimes when you talk about a vision, when you talk about life goals, money, financial freedom is just one of them. Reason being, here I'm deviating a bit because it's not because financial freedom, you may actually have financial freedom, you have money, but you are sick. You have money, but you are actually what people are actually accusing you of actually being an academic dwarf. You have money, but your relationship are in tatters. You have money, but you are going to hell. So that's why I normally say whenever you are talking about life goals, there must be a balance. You must actually have what you call a balanced life goal. So in short, financial freedom is just one of it. So what the vision should actually be to lead the quality of life. So the goal is actually having what we call financial freedom. So life goals, so financial freedom will actually come from what we call your vision. What exactly do you want in life? Once you have made a decision what you want in life, you can actually decide for me to achieve it, first I must actually have money. Because you cannot achieve a vision without money. Just like in our country, as a country, you cannot say in Kenya we are going to achieve our vision 2030 without money. We cannot say we are going to achieve the Big Four agenda without money. We cannot say we want to achieve the better bottom-up economic transformation agenda without money. So your vision will actually be dictated by money. Remember the things you said, even things to do with your career, even things to do with the, what else, health. All of them actually, money will actually be the informer. So the life goals will be translated to financial goals. So once you decided your life goals, you now actually come up with the figures. What figures support the goals that you want to achieve in life? And those goals will actually be achieved based on actually the wealth that you are building. You have to build wealth. Building wealth simply means that first of all, you're actually not spending more than you are earning. That's number one. And that's not the only one because you could actually be spending less than what you're earning and you're actually saving a lot of money. But this money is not growing. If the money is not growing, again, you'll not be able to achieve your goal because the goal will actually be achieved by wealth. Now, so once you have decided the goal and you have decided the wealth, we actually have to develop what is actually the plan do I have to increase my wealth. So how do you achieve the goals? First, we have income. The issue is not where we get our income because often it's actually from employment, from passive, or from inheritance. There are many ways of getting income, but how do you manage that income? Manage the income. How do you manage the income? First, ensuring that you are not living beyond your means. That's the first thing. But that's not what we are dealing with. We want to live with number two. Optimal risk management. Remember, if you have income, we said you actually have this money cannot stay in your pocket. So you have actually to invest the money. Number two, so we'll actually talk about optimal risk management. How do you manage risk? So in short, what we are saying, you must take risk, but the risk must actually be well managed. So when you talk about risk, we are talking about tax will actually fall there. The issue of actually investment returns and risk and returns will actually fall there. Creating a portfolio will actually fall there. Then we actually have what we call any investments must actually have something in mind. That's why we normally say, are we investing long term or short term? Do you want to invest in infrastructure bonds? Do you want to invest in treasury bills? Do you want to invest in the money market? Do you want to buy land? Do you want to buy the stock? Do you want to invest in the stock market? Do you want to invest in cryptocurrency? The reason why we ask those questions is because, first of all, there must be something you want to achieve in investing in these things. And if you invest without a plan, it's what we call playing a poker, but not looking at the cards. I know we know what that means for the guys when those when we used to play cards. For you to play the poker, you actually have, if you don't look at the cards, you are going to lose. So if you invest without a plan, it's okay. But it's actually playing the game of cards without looking at the cards. The chances of winning the game are between 0 and nil. So that's why I say any investments must actually have what we call a plan. So let's look at the tax now, because that was actually a introduction. Let's look at actually the strategies that we use in actually managing our taxation, because managing our tax, we say tax eats about 50% of our income for the guys who are actually in the upper corporate ladder, in the upper ladder. For those who are in the lower ladder, again, it also eats not as much, but it actually consumes a lot. So how do we manage these taxes? Actually, a way of managing, increasing our wealth. So in this world, nothing is certain but death and taxes. How true is that? This was said by Benjamin Franklin. How true is that? Can I have interjection? Everybody can actually tell you whether we believe it's true or it's not true. Who can try? Just give your thoughts. How true is it? Okay. In short, the question we're asking here, do we have people, what we are saying, everybody is going to die. It's certain. But it's also certain that everybody is going to pay taxes. Is it true that everybody pays taxes? That's the question we are asking. Remember, we have people who don't have income. Eh? If you look at the data we have, the people who pay taxes in this country is about 3 million, about 3.1 thereabout. Eh? Those are the total number of population, the people who pay taxes in this country. So in short, what we are saying, we actually have people who, no, we are, and the people, the total workforce will actually be about 14 million, thereabout. So what it means, we have 11 million people who don't pay taxes. Reason? Because either they don't earn income or we don't have information about them. We, or their income is actually less than the threshold. Eh? They have not hit the threshold. So do these people pay taxes? So these people, we say they don't pay taxes because they file nil returns. So we are talking about more than 3 million people filing nil returns, but we have to talk about another 7 million whom they don't file and we don't have information about them, like our parents in our country. So do these people say, if these people don't pay taxes, it means this statement is not true. But if you look at it, is it true that the guys don't pay tax? No. Everybody pays taxes. Reason, we actually have a false belief that tax is actually what we call PAYE. And the tax is not PAYE. We have what we call VAT. These people consume what we call vetable goods and services. These people consume what we call exercisable goods and services. These people attract what we call custom duty. If you are buying electricity token, these people, if they pay for power, they pay taxes. Eh? So the statement is true. Now, so the tax framework in Kenya, that is actually what we call the tax structure in this country. And what we want to ask, how does it affect you? Which area affects you as a person? So that if we can talk about tax management, where are we going to manage our taxes? So the taxes will be divided into two. We have what we call direct taxes and indirect taxes. Direct taxes is what we call PAYE, the one that you cannot avoid. That one has actually to be, you have to pay from your income. What does it mean? When we are talking about tax management, we actually have to manage that element of tax. For PAYE, we have to manage it because you cannot actually, because it's going to catch up with you. Then we have what we call withholding tax. Withholding tax is very hard for us to manage it unless you are a consultant. Because if you are a consultant, we are allowed actually to factor our expenses in actually coming up with our income. So since you can deduct our expenses, remember a consultant is actually allowed to drive to work. He's actually allowed to eat lunch. He's allowed to incur most of the business's expenses of a consultant are tax deductible. So in short, they can actually be able to address it. They can actually be withholding tax. They can actually be able to manage. Then we have what we call business tax. Often when we say business tax, we'll actually talk about things to turnover tax, We have another one that we used to call minimum tax, which was actually kicked out by the courts, which we believed was a good tax because it was going to punish the guys who have actually been loss making. And then we also have what we call any other business, any other business when we talk about rental. So when we talk about business tax, we are talking about all the businesses. So we talk about issues to do with rent, to do with turnover tax, to do with the corporate tax, EPZ, those who have what we call preferential tax rates. So all of them will actually fall into that. So in short, it is not just corporate tax, it's actually all the other endeavors. Then we have what we call indirect taxes, VAT, which is actually three. We actually have what we call the standard rate, zero rated, and exempt. With the last 12 months, we have been moving towards doing away with zero rating. Reason, zero rating has created a lot of chaos for the taxman, where we'll actually have what we call a lot of refunds backlog. The intention to do away with zero rating so that we only have we have two taxes. We have exempt and standard. What does it mean? So that the goods are either exempt or actually 16%. So we do away with what we call the claims of VAT. Now, I believe that is actually the trajectory that we are going to move in. Then we have what we call custom and excise. Custom, if you import any goods, we normally, when there is goods that are exercisable, then we have what, not, so I mean, you pay custom. And remember, but for excise duty, that's the one that we used to call sin tax, is charged on what we call luxury goods and services. So that if you produce things to do with alcohol, cigarettes, or anything that is either undesirable or you want to protect the people from using it, things like plastic papers, when you are actually doing them, will actually be charged excise duty. So it was called sin tax because actually for luxury goods or goods that are actually not desirable. It is so if you put airtime in your phone or you actually withdraw money, you actually have what you call financial transactions. They are exercisable. If you use your phone, you deal with Safaricom, the services you get are actually exercisable. So it's good to note if you import like a motor vehicle and it's brand new, we are saying because you are importing into the country, you pay custom duty. But you'll note that apart from before you pay, you are going to pay custom duty. You're also going to pay excise duty. You're also going to pay VAT. You're also going to pay railway development levy. You're also going to pay import declaration fee. So again, this tax you actually find for some items you are going to have more. So all the taxes. So I've just talked about one where you'll actually find just one import, but you're talking about three or five. We are talking about three taxes. You're saying it's attracting both VAT, customs, and is actually attracting excise duty. So it's one item, but it will attract all the three. So how does this structure affect you? So as a person, you'll actually find that actually you actually have to manage what we call personal taxation, which will actually be looking how do you manage it. Number two, you'll also have to manage VAT. What what services are vetable, which are actually exempt? Then the other services is what? Custom and excise. How do you manage this? I know for some of us, based on our consumption habits, we cannot say that we are going to consume what is called non-vetable. But it's good to know that if you take bottled water, you take luxury goods, you will not escape from these taxes. Now, tax planning versus tax crimes. When we talk about managing our taxes, mitigating our taxes so that we pay less tax, we are talking about planning our taxes. Remember, anytime we come with what we call a tax planning mechanisms, it's actually meant to actually avoid us paying tax. KRA will actually come with a legislation to curb that gap. So it's always good to actually differentiate between tax planning and tax crime. Why? Because some people say we are actually tax planning, but in the real sense, what we are doing is not tax planning, is actually tax crime. Those are some of the things that some of the entities have actually been on the radar, saying that we are tax planning, but in the real sense, what we are engaged is actually tax evasion. So tax planning versus tax crimes, what is the difference? When we talk about tax planning, it's what we call tax avoidance. You want to utilize the tax regime to one's your advantage through the legal means. You want to reduce the tax burden, you want to ensure you pay late, or you avoid penalties, or you actually manage the risk associated with taxation. That is what we mean by tax planning. Then tax evasion is actually using illegal means, reducing our tax by illegal means. Now, it's good to ask how thin is a thin line? When you talk about tax planning and tax avoidance and tax evasion, how thin is a thin line? Reason I've told you that if we come up with tax avoidance mechanisms, the taxman will always find a way of actually catching up with us. So tax crime, we normally say oftentimes we commit tax crime willingly or unwillingly because we don't have information. Why do we commit tax crimes? First of all, you have what we call ineffective tax planning measures. If we don't plan, you find the money, by the time you need to pay the taxes, you don't have it. This happens with people with side hustles, what we call business. If you have a business, you have been doing business for the last 1 year. A time has come, you are supposed to pay tax, but you don't have the money. So what we do, we'll actually come with actually clever ways of actually not paying taxes. One, the best way to tax plan first is actually to comply with actually the tax laws. That's actually the best way of actually tax planning. Then at times we don't pay tax. We actually don't, we commit tax crime because we do not have information. We don't know. Then we actually have what we call unrealistic tax regimes, where you are being told withhold tax withholding tax should actually be remitted within 5 days after deduction. Then we actually say we do not, there's no time. It's actually unrealistic for us to remit within 5 days. Then there's a time where we say the tax authorities will never catch up with us. Reason, this is how we have been doing things and we have never been caught. Then we have people actually, we don't have discipline. We don't have self-discipline. Then where we say this money is being eaten. So even if we pay, it will be eaten. So it's payback, we are not going to pay. So examples, willful failure to file returns, where we prepare false returns. Split payroll, I'm not sure it still happens, but it used to happen with some sections of Kenyan's community, where you'll actually find people are earning peanuts, but the people are very happy in that organization. And we ask ourselves, how comes you're not earning good money, but you seem to be doing very well? Aiding in preparation of false documents. And then we normally say, some people, if you are in business, you keep 2 sets of books of accounts. One for KRA and one for yourself. And the one that will be audited will be the KRA one. So that is actually tax crime. So how do we manage the taxes? How do we do tax planning? First, leverage tax release and deductions. So we actually have what we call deductions that actually are deductible when it comes to actually what we want here is actually to reduce the amount of tax we are going to pay to the taxman. So the first thing, affordable housing levy is now deductible. So we are saying you deduct it from your salary and you are going to get a house. Not that you have a right to get a house, but you have an opportunity to get a house. These houses are actually the cost is actually lower than what you can get in the market. Then post-retirement medical contributions. If you are contributing money for your retirement, for your medical contribution for retirement, it's actually tax deductible up to 15,000 per month. Then we have SHA. We have mortgage. If you have a mortgage, the people in the public sector, they get mortgage at very low rates, lower than what the market can offer. So they get them at 3% or a figure like that. That is actually something that you don't think twice, you pick. But we don't encourage people to actually take a mortgage as well if it's in the market value because of compounding interest. Because of actually, if any debt that you take that is very long term, is 10 years, 15 years, is going to actually get you into a trap. But if the interest is lower than what the market is offering, is something that you don't think twice, you pick. Now, again, this interest is actually deductible up to 30,000 shillings per month. So in short, you can actually have your premises, and once you do your premises, you are going to enjoy tax. Then pension. Now it's actually 30,000 shillings per month. Pension is good contribution because it reduces the tax you are going to pay to the taxman. And when you retire, this money now is not attracting any tax. So you are going to get your pension, all of it, without actually it being taxed. So now we don't talk about the issue of senior citizens, because sometimes back we'll actually say only senior citizens were exempt from taxation on their pension. Now it's actually everybody once you retire. So contribute to pension will actually ensure that you get less amount of, but will actually your take home is less. Because of that, your tax will actually be less. The intention is actually to starve the taxman. Number two, utilize allowable expenses. If you are a business, you will actually ensure that all the allowable all the deductions are actually allowed. Business can deduct expense only and expense incurred in generating taxable income. This include, so I'm saying that because at times when you are doing rent, we normally deduct what we call KRA will actually ask for 7.5% of the revenue that you have collected. And we don't allow what we call allowable, we don't allow any expenses. My experience is that I try to handle the issue where we actually tell KRA, my client needs what? My clients need to actually register. Since the building, we are a company, the buildings are actually in the business. So we want to pay corporate tax when it comes to issue of rent of property. So that if I collect a rent of actually 10 million, I'm willing to pay you 30% of that money, of course, less the deductions. Reason for you to build a building, the expenses are actually very high. They allowable. We have what we call wear and tear. We actually have what we call the first utilities. We have so many things that we can actually deduct. But of course, we have not been through on that angle. So that is, if you are a business, you actually deduct all the expenses. Incorporate tax incentives. So if it's a business, we talk about capital deductions. Investment in buildings, machinery, other capital assets qualify for wear and tear allowances. So then we have what we call, if your EPZs do not pay tax for the first 10 years. This is something I wouldn't want to talk much about it for political reasons, but it's something that these guys are always very clever and ahead of us. That after 10 years holiday expires, we do not have a case where 10 years have expired and the EPZ has started paying tax. They'll actually come with a clever way of actually rebranding or something. Then we have special economic zones. If your business is actually outside the cities of Kisumu, Mombasa, Nairobi, those big cities, you pay what we call reduced corporate tax of 10% for the first 10 years and 15% for subsequent 10 years. Of course, we have a new angle where we are saying that this business must actually prove that they had the capacity of actually being domiciled in these cities. So if it's a cement manufacturing companies and in Loitoktok, we cannot say that they are outside Nairobi or Mombasa or Kisumu, because were they to be in Nairobi and Kisumu, Mombasa in the first place? If they were not to be there in the first place, then it would be hard for us to allow them, to call them special economics, to allow them this, because by their very nature, they were meant to be outside these zones. Then optimize employee benefits. So what we say for employees, if you want to deduct to them to enjoy this benefit, you actually avoid giving them cash and give them benefits in kind. So employers can provide non-cash benefits to employees, such as housing, medical cover, or company vehicles, which attract lower taxation. So benefits valued at under 60,000 shillings, that is actually 5,000 per month, are excluded from taxable income. What are these benefits? We normally talk about food that we give to employees in case you are actually in a place where if they are provided meals in the organization. We also talk about issues to do actually people are given not airtime. You are given a phone, and this phone, I mean the airtime, but the airtime is not given in cash. If you are given airtime and it falls within this bracket of 5,000 shillings, we'll actually say it's actually excluded. So meals provided by an employer valued at Kenya annually are tax exempt. So in short, what we say is actually move away from cash benefits to non-cash benefits. Don't give employees cash. For example, we've given the example of a phone. If you give an employee 5,000 shillings, to put airtime in the phone. That will go to the payroll and will be taxed at 30%. But if you give them the airtime, if you give them airtime directly, it will, if it's less than 5,000, you will not pay tax on it. Loans to employees, benefits in kind, home ownership, telephone benefit means, I think we said that. Then adopt proper business structure. So if it's you have a side hustle, come up with what we call proper business structure. Legal. If you are an entrepreneur or you are in partnerships and you made a profit of maybe 3 million and you are three partners, each person will actually pocket 1 million. That million will actually be taxed at the graduated scale on the person rather than being taxed at 30%. Because if you are a company, the 3 million will be taxed at 30%. That is 900,000. So it means 2.21, it means 2.1 million remains for the three partners. And once we give them dividends, remember we said there is withholding tax. But if you call it partnership, the profit is actually divided among the partners, and so it lowers what we call the tax. Or limited liability company to optimize tax liability. Limited liability company, the good thing about them is actually they're allowed to deduct all their expenses. Then if you have a, if you are if you are actually a business, you can actually decide, do you want to be a consultant or to actually be a company? So for example, we said consultants are allowed to claim their expenses. An employee is not allowed to compute the expenses, to claim the expenses. So is there an advantage of being a consultant as opposed to being an employee? I think here there is a trick. Because I have handled one case 2 years ago where this is a hospital setup and they have their doctors. And the doctors are their employees. But they also have another wing. In this other wing, the doctors are actually considered consultants. So the question was, are the doctors consultants in this other wing? And if they are consultant, means we normally deduct 5% of what we pay them. So in short, the doctors are getting two income. The first is actually what we call the from the company, from the hospital. But here in consultancy, they are getting what we call their money less withholding tax of 5%. And the question was that okay? That's what they had done over the years. But now the problem has come. They actually they have started, finance is actually saying, you are not a consultant, you are an employee of this other department. And becomes actually a serious issue. And when the KRA had gone to this, address the same issue, and the question was, can you be a consultant of this wing, this other organization? So that's something that needed to be addressed. And when we are addressing, we look at actually another case where a certain university had an issue some years back, where the lecturers are actually full-time employees of the university. But again, we have evening students. These evening students, you teach them, and actually you are a consultant there. The question is, are you a consultant? And the answer is, you are not a consultant. Reason? Who owns this other special vehicle that you are talking about? You cannot actually be an employee of your organization and you are a consultant of a special vehicle that is actually owned by your employer. So for us to decide who is a consultant, we normally say, who control, are you under control of the entity? What about your resourcing? Who provides your resources? Where are your offices, tools of work? Then about your administration, who approves at what time do you report to work? So they actually ways the way, if you look at the way consultants behave, consultants are actually basically independent. If you are not basically independent, we'll actually confirm you are actually an employee of the organization, and the person who will be punished is actually the organization for making you as a consultant. Remember, for this one, you're talking about the university, you'll earn your salary, then they deduct, you'll get the allowances, they deduct 5%. So the consultants they know a better way of actually not paying the remaining amounts. They're able to claim their expenses. So the taxman suffers. And the person who will be punished is actually the organization that actually classified the employee as a consultant. So if you become a consultant, you are going to actually enjoy more benefits, lower taxes. Tax planning strategies if you have a business, you register under the turnover regime. Reason, the turnover tax is actually 1% of gross income and is actually favorable. So that if your revenues were 50 million, we don't look at how much profit you made. What we look at is actually what was the turnover. Then it also exempts you from actually preparing what we call elaborate financial statements. What is the reason? Because we are paying attention to the revenues, not actually at the expenses. Then plan for withholding tax. Remember we said withholding tax you are remitting within 5%, 5 days after deduction. What does it mean? If you actually deduct, if you actually, not deduction, when it becomes due. So when does withholding tax become due? It becomes due after you've actually paid after the consultants have been paid, the withholding tax becomes due because you have actually withheld the withholding tax. So what we do is actually, how we plan is actually to align the payments so that we don't actually have to be paying people every week. We normally say we are actually going to do all the payments twice a month or once a month so that we don't have we don't have a full team doing withholding tax every day. So that we can actually, that's how we'll manage. Then number 8, invest when you are doing investments, you want to grow your income. We said you are going to invest in land, you are going to invest in actually stock market, you are going to invest in money market fund, you are going to invest in infrastructure bonds, in infrastructure bonds, in treasury bills. So invest in tax exempt instruments. If you invest in money markets, you are going to be there'll be withholding tax of 15%. And if you're a business, that 15% is not final. If you invest in actually infrastructure bonds, they are tax exempt. So you look at actually the instruments that actually are exempt, income is exempt from tax. Then strategize on VAT. So ensure that you're actually able to do documentation so that we're actually able to claim all the input VAT. If it comes that there is a VAT you are not able to claim, the VAT becomes a cost, an expense to the organization. What is going to ensure the VAT does not become an expense to the organization, we can actually be able to claim it. What does it mean? It means that we actually do business with actually entities that actually have fiscalized which are actually ETIMS compliant. Then engage in estates and succession planning. So if you die and you leave your money, before your beneficiaries get the money, the tax man is actually going to ask for tax. Proper asset may ensure minimal tax exposure on wealth transfer. If transferring your wealth to your beneficiaries is going to actually attract what we call taxation. A serving in trust or gifting assets during one's lifetime can mitigate future tax obligation. If these things are done when you are alive, it becomes easier. That your estate does not actually remain, does not actually, you don't start paying tax when you have actually left the world. So those are actually the 10 ways of actually managing our taxes and actually strategies for minimizing our tax exposure, both at individual level and organization level. So tax, a matter of life and death. Then the Pharisees went and plotted how they might entangle him in his talk. Is it lawful to pay taxes to Caesar or not? There is actually a statement we say some people say we will not pay tax because it's a payback period. That these people have been eating our money. They have been telling us to pay SHA, to pay housing fund, and we have gotten a chance. We will actually be able to hit them here. So what we're asking, is it right to pay taxes to Caesar or not? And the answer, we all know what we are told is actually you render what belongs to Caesar and what belongs to God. What does it mean? That we should pay taxes. Thank you very much. Any question? We can open the forum. It's already one for the next maybe 10 minutes, and we have a question and answer session. Joshua, back to you.
Okay, thank you, CPA, for the presentation. So maybe just the way you've asked, is there anyone with a question or any concern? You can feel free to raise your hand so that I can see you. Okay, with the silence, I'll assume there's none. So I would like to give it back to you, CPA, in case you have something even before I wrap it up.
Yeah, okay, thank you. Mine is actually appreciation for giving us the chance and opportunity to engage the team. And I believe we have added value. So I wish to thank everybody. And maybe I know we did not start with a word of prayer. Maybe we can actually close with a word of prayer from any of the team members. Thank you.
Okay, thank you, CPA. So I'll also join you in thanking the team for having gotten time to learn. And I think majority have learned a lot. So moving forward, feel free to join us for the webinars that are upcoming. And about the certificates, I think they'll be shared to your emails before the end of this week. So that's the end. And thank you once again. I would like to invite anyone who can pray with us. Is there anyone who can volunteer and pray with us? Oh, if there's none, I'll just proceed and pray. Let's humble ourselves wherever we are. Our Father in heaven, we come before you this afternoon. We thank you for the opportunity that you gave us even to meet together as a team and also learn. We also thank you for CPA for the nice words and also the knowledge that he has given us this afternoon. We pray so that even these things that we've learned, let them be of help unto us, not only us, but also to those who will be practicing them together with, be with them wherever they are. This afternoon, we ask your Spirit to lead us and be with us through the day. Jesus Christ, and believe. Amen. So you're free to leave. Thank you.